Hi, this is Justin from Money Bootcamp. Today I'm answering a question on home mortgages. Buying a home, should I get a fixed or variable rate mortgage? Quick definition for people. A fixed rate mortgage means that you are getting a fixed interest rate on a mortgage. So if I get a 10-year fixed mortgage rate, I'm going to pay the exact same amount of money every month for 10 years on my mortgage repayments. If I'm on a variable rate mortgage, it means I'm going to pay whatever the market interest rate is plus a certain markup. What that means for me is that if the base rate, which would be the ECB rate typically in Europe, goes up or down, my mortgage payments are going to go up or down as well. With this in mind, a variable rate is cheaper, but it's also riskier. So if you are looking at this, it's not a straight cost comparison. You need to think about what are the risks of paying a different amount if something happens that's outside your control, because interest rates are outside of your control. So most people will get a fixed rate to initially start their mortgage. So they might get a 1 or a 2 year fixed rate, or some people will go straight for a variable rate if they want a variable rate. What you need to do is think about where you will be in your life when the initial fixed rate finishes, or if you're just going on a variable rate anyway, what are your risks? Let's just assume you have a very short fix initially, you have a 1 or a 2 year fix. You need to think about where you'll be when that fix ends. Are you going to have kids? Are you going to have a better job? If you've had kids and you're a couple with 2 incomes, will you actually now only have 1 income? Will one of you take work off so you can actually mind the children? So you need to think about this and what other commitments you will have when your short-term fixed rate ends, or if you're going to be on a variable rate, how this will change over the years as you will end up in different personal and career situations that will change your lifestyle and what you might be able to afford to pay. With this, you need to know your situation. Then you can look at the cost comparison and then look past the cost comparison. If you look at the direct cost comparison, you might be able to say, okay, if I get a fixed rate now, I can save €100 a month, €200 a month, whatever it is, okay? That is the actual cost comparison right now. You need to look past the cost comparison now is that your life will change, and if you're on a variable rate now, the interest rate could go up tomorrow and you would be paying more. It could go up next month and you'll be paying more. You have to look at your life and see, can I actually afford this? Do I have the wiggle room that if my interest rate went up, I'd be able to afford it? We don't really have to worry about it going down in this case, because if it went down, you're going to be paying less and you can afford to be paying less on your mortgage. The concern is if it's going to go up, can you afford to pay and live a comfortable lifestyle and do the things that you want to do if it was going to go up? If you're on a variable rate and it was going to go up by €100 a month, €200 a month, €500 a month, whatever it is for you, look at a mortgage calculator and play around with the interest rates and you'll see the different prices and what this could mean for you if interest rates were to go up. You need to balance this risk of it going up with the actual cost itself. So let's talk about the benefits of both approach. If you're on a variable rate mortgage, you have flexibility. You can move easier if you're looking to move home. You can pay it off early if you want. So although your mortgage repayments might be lower because of the interest rate, you can actually overpay and pay off your mortgage a lot faster than you would otherwise. It's definitely going to be cheaper in the short run, and you may be able to get a better rate later on if the market changes and interest rates go down. If there's more competition in the mortgage market, you might be able to get a better rate later than you would now, or in comparison to if you stayed on a fixed rate for the whole time. So the benefits of a fix is that it is predictable and you get peace of mind. So if you fix for a 5 or a 10-year period, you are guaranteed to be paying exactly that same amount regardless of what happens in the greater economy, if interest rates in the economy go up or down, you know exactly what you're going to pay. So there is a peace of mind that comes with this. You're giving up flexibility, but you're going to have that comfort there. Why are we talking about this more now than we would in the past? The reason is that fixed rate mortgages are on the rise. They're becoming a lot more popular. Some of the banks are offering longer terms with this, and more people are actually opting for fixed rate mortgages than we would have seen previously. There is also a point that ECB rates, which are the core rate for most of these products, are at the lowest they've ever been at. So it would be very hard for them to get any lower. With this in mind, they're almost certainly going to rise. Most economists are predicting they'll rise it. They have stated themselves they are planning to rise the interest rates. So it is really very likely that interest rates are going to rise over the next few years. So going onto a fixed rate ensures that if they rise, you're going to be on the same rate regardless of this. This doesn't mean that it's the answer for you. It doesn't mean it's actually going to be cheaper in the long run anyway. It's just guaranteeing where you're at and what you're going to pay. It may not be the right answer for you, but it is definitely the way the crowd is moving right now. So that is something to think about when you're looking at fixed rate and variable rate, where you're going to be in your life. Look past the cost comparison and then think about the risks that it would give you if your mortgage was to increase. Would it really affect your lifestyle, or can you afford it either way? This has been a Personal Finance Friday question from Money Bootcamp. If you have any questions that you would like answered, please send them our way. We do new videos every Friday. Money Bootcamp, learn money, live better.